Hey guys, so this is week 1. It's Accounting 1010, and I wanted to go over some of the learning this week, really kind of talk about a few things in relation to the foundational principles that we are learning this week. This kind of starts us off where we're going to talk about, well, the text talks about business organizations. Some of my discussion questions have been along those lines, which we have learned: sole proprietor, partnership, corporation. There's advantages and disadvantages to both. Different types of careers you can have in accounting, whether it be an accountant, you could be a bookkeeper, you could be a payroll accountant, you could be a CPA, certified public accountant, you could be a CMA, a certified managerial accountant, you could be a CFO. There are a lot of different opportunities in the accounting field. You could even be in forensics accounting. So it kind of opens your eyes up to all of that. Also, the learning discusses the different types of principles that guide accounting: GAAP, GAAP, generally accepted accounting principles, and the different boards that govern those principles, like the FASB, the GASB, the IASB, the AICPA. There's so many different things. The SEC, the Securities Exchange Commission. So all these different things, and it's important that we understand what those boards do, and we understand what the principles are that kind of govern the accounting that each business does, whether it be here in America, internationally, whatever it is. There's different rules for different locations. So these are all kind of foundational things. Really good learning to know. There's a brief discussion in the chapter regarding ethics. Ethics is super important, and I want to make sure that everybody understands that working in accounting, there is a high level of accuracy, honesty, making sure we're not falsifying information. I learned when I first started accounting that it was important that I was a fiduciary for the company, meaning that I was responsible for the owner's assets and I was going to handle them responsibly and correctly, honestly. So ethics in accounting is very important. We don't want to falsify information. We don't want to change numbers. We don't want to make a company look better than they are actually doing, or even look worse than they're actually doing. For tax reasons, I've heard of cases where that's been done so they can not pay taxes. And also I've heard of cases where they've made a company look better so that they could get credit, they could get extended loans, things like that. So ethics, super important in accounting. Just wanted to throw that out there. So with the main learning this week, I think it's important that we all note, and I was trying to see where in the text it was, but I will get there in just a second. If you look in your text, yep, right here, page 12 and 13, this kind of starts the beginning of what I would say foundation. A equals L plus OE, or SE, if you will. So it's assets equals liabilities plus stockholders' equity. This is the foundation for the balance sheet, the income statement, the statement of cash flows, the statement of stockholders' equity. So it's important that this equation become part of your life for the next 8 weeks. And if you go on to accounting 2, then part of your life for that too. If you're going to be an accountant, then it's important that you have this data. Assets equals liabilities plus stockholders' equity. So what does this mean to you? This means that if you had $10,000 in assets, right? And you had $2,000 in liabilities, how much do you have in stockholders' equity? $8,000, because A has to equal L plus SE. It's not big time math in accounting. I think a lot of people think that accounting is all about math, but there's some adding, subtracting, dividing, multiplying. It's not a bunch of algebra. This is like the primary equation that we're going to use for our accounting learning. So assets equals liabilities plus stockholders' equity. And I think what this really shows us here is that it brings our balance sheet into balance. So when we go down our balance sheet, if you look on page 13, you will see an example of a balance sheet. And you will notice that on this balance sheet here, and I can show you too because I have the text right here. So if you look at this balance sheet, make sure you go there, page 13. You will see that there is a section for assets. What would be an asset? Cash, accounts receivable, inventory, prepaid, property, plant, and equipment. All of those are assets. What's an asset? It's something that you own. It's something that the company owns. It's theirs. Okay. So then there's a total for that. And then as you work your way down for liabilities and stockholders' equity, you see liabilities are what you owe. So there could be a current liability like accounts payable, which turns over in 30 days. Or there could be a long-term payable or liability. That would be like a note, a bank loan, something you would owe a creditor, but it's going to be longer than a year, basically. So then after the liability section, you're going to get into the stockholders' equity. So stockholders' equity is basically what belongs to the owner. So that would include, right, common stock, retained earnings. It would include any dividends that the owner had taken out. So it's important that you get an idea of this, the A equals L plus SE, because everything in accounting has to balance. Credits will always equal the debits. Assets will always equal liabilities plus stockholders' equity. So when you have your balance sheet prepared, they all kind of feed into the other. So your income statement, which is actually, if you flip it over to page 14, your income statement has your revenue and expenses. So revenue minus expenses equal your net income or loss. Net income would mean that you actually had more revenue than expenses. Net loss would mean that you had more expenses than revenue. So we don't want to go that way. You want to have more revenue than expenses. So then if you work your way over to page 15, you'll see the statement of stockholders' equity, where it really breaks down what it looks like from common stock to dividends to what the net income was on the income statement, because all of that, whether it's a loss or an income, rolls over to stockholders' equity at the end of the year. So you have a lot of opportunity to look at the different financial statements this week in Chapter 1. Right now we're just talking about Chapter 1. I'm going to talk about Chapter 2 in a little separate video. The other thing to note is accounting, the accounting cycle, the accounting periods. We can report monthly, we can report quarterly, we can report annually. Most companies are on a fiscal year. So the fiscal year is going to be January to December, or possibly, like, for example, I'm in Michigan, so the state of Michigan may be October through September. Whatever the fiscal year is, that's how you report. A balance sheet starts the company at the very beginning and it continues forever. So those beginning numbers are always there and they're either added to or subtracted from for the life of the company. It never zeroes out. An income statement, it's based on period. So if you have your fiscal year, at the end of the year, you have your ending numbers on your income statement. So your total revenues, your total expenses, total net income or loss. When that year rolls over, so 12/31, you have those numbers. When the year rolls over on 1/1, you start over. So those are some interesting things about accounting I think you should know. So I'm going to get to the next video, which is Chapter 2, but that's basically in a nutshell Chapter 1. So what's the takeaway? A equals L plus SE, right? Assets equals liabilities plus stockholders' equity. They must be in balance. The balance sheet has to balance. So that's something you can take away from this as well for your assignments. If you have a balance sheet that does not balance, then your answer is not going to be correct, because I hold it to the A equals L plus SE. Thanks. See you next video.